Bonds began the overnight session just slightly weaker and then held perfectly flat with the Asia session. In the domestic session, UMBS were down 14 basis points on the open as the market continues to digest and debate the future in light of the light CPI yesterday. With investors and the Fed in a face-off over the future of rate decisions, they're going back and forth. Volatility will remain elevated until such time as one of them blinks. This uncertainty should keep the bank's mortgage demand on the side through probably the beginning of summer. December import prices rose 0.4% month over month after falling 0.7% the previous month, according to BLS. Estimates of 0.9 negative were quite a bit of a beat. Reprice risk on the day was low. Should be a pretty quiet day, and it pretty much was. We aren't likely to see rates drop much further unless we get a dovish message from the Fed at the end of the month, and it's not looking like that's coming. Fed members are still towing the company line that the Fed rate needs to be above 5% and not come down in 2023. Consumer sentiment improved in January, according to the University of Michigan. Inflationary expectations fell from 4.4 to 4, which is good news for those who want the Fed to take its foot off of the brake. Consumer sentiment is still awful overall, stuck at the levels seen during the Great Recession. Apartment list rental rates rose 5% year over year, according to data from Redfin. I guess it wasn't apartment list, it was Redfin. They were down 1.4% month over month and off 3.6% from the peak set in August. Some of this is seasonality. However, the massive growth we saw in 2021 is over, and rents will generally lag home prices by 21 months or so. The inversion between the 10-year and the 3-year Treasury is almost 120 basis points, strong correlation to a recession. At the end of the day, we were down 20 basis points, ending the day at 101.47, which puts us right underneath that flat Fibonacci 38% retracement at 101.671, with a very tight range and lots of floors. So we have 4 floors, a convergence of floors. It's nice to be wanted, and the agency mortgage-backed securities spent QE4 era having a dance card constantly filled by not only a voracious central bank, but actually U.S. banks in general too. However, the Federal Reserve has stepped away and is allowing $11 billion or so each month to run off its balance sheet, while the largest domestic banks, which increased their agency mortgage holdings by 36.1% from March of 2020 until 2021 year end, have seen their holdings since drop 7.2%. Still, large banks' aggregate holdings come to $2.1 trillion, which is nothing to sneeze at. So the question becomes, just how robust might bank demand be in 2023 over the near term? At least the answer is not very likely. So they might be starting to sell some of that off, especially when you hear stuff like Wells Fargo, which reported fourth quarter earnings were half that earned the same quarter of last year. Elsewhere was better bank news. JP Morgan Chase and Bank of America both beat analyst estimates. Next week, we are closed on Monday for MLK Day. Wednesday, we will get core producer prices as well as a 20-year bond auction. And then on Thursday, we get a 10-year note auction with jobless claims. So it should be a fairly quiet week next week. If you have a long weekend, check out some of our sponsors, especially WellThatMakesSense.com. There's a special post stream going on over there from the book Traction. So if you have goals for this year, Traction is your plan and your operating system for getting that done. Have a great weekend. Take care.